Gold, real estate, or ETFs? We've all heard the arguments for each. They are the three pillars people constantly argue over at dinner parties. But as a focused learner and a truly smart investor, you need to know which of these three heavyweights is the true, undeniable wealth compounder. We're going to break down the source data today to give you a clear, undeniable answer.
Okay, let's dive into this. Contender number 1, the real estate reality. Look, real estate is the classic traditional choice that generation after generation has touted as the ultimate goal, right? But when we actually subject it to rigorous scrutiny, the whole myth kind of starts to fracture. I mean, you need a massive amount of upfront capital literally just to get in the game, and then you're left holding a highly illiquid asset. If you need cash tomorrow, there is no way you can sell a house in a day. Add in the constant management headaches and the endless ongoing maintenance costs, and it places this exhausting financial burden on investors. It's essentially a second job masquerading as a passive investment. Moving right along to contender number 2, gold, the financial shield. Now, gold is, well, it's fascinating, but it gets completely misunderstood as this massive growth engine. Actually, scratch that. It's really more of a safe haven. When the stock market gets rocky, it's a very secure place to park your cash and track gold prices without taking on inherent stock market risk. It's a brilliant shield that perfectly preserves your wealth, for sure, but it absolutely does not aggressively multiply it. It's for defense, not an aggressive offense. And finally, contender number 3, ETFs, the ultimate winner. And this brilliantly illustrates why this is the undisputed champion for the modern investor. ETFs trade live on the exchange, just exactly like a stock, which gives you pure liquidity. Plus, they come with 0 exit loads, which means no hefty penalty fees when you decide you want to cash out. Compare that to real estate, where selling takes months and costs you massive realtor fees. With ETFs, your money is completely free to actually compound for you without being locked up behind endless red tape. But hey, liquidity isn't the whole shebang. We literally have to look at the ultimate wealth killer, fees. The massive fees typical of traditional mutual funds act like this heavy anchor, just quietly draining your returns year after year after year. ETFs, on the other hand, utilize a hyper-efficient, incredibly low-cost structure to let your wealth actually grow without that constant drag holding you back. Now, what's really interesting about this slide is that, according to our sources, you can access ETFs with fees as spectacularly low as 0.05%. I mean, 0.05. That is practically invisible. By keeping your costs this low, it is the ultimate wealth preservation tactic. More of your money stays right in your account doing the hard work of compounding rather than paying for some active fund manager's brand new yacht.
And the best part? You aren't sacrificing growth for these low fees either. ETFs give you instant, direct diversification across top-performing companies, like the high-growth tech of the Nasdaq 100. In fact, you can start doing this right now in 3 really simple steps. First, go open a low-cost brokerage account. Second, select a broad market ETF that actually aligns with your financial goals. And third, set up automated monthly contributions to just let compound interest do the heavy lifting for you. It's that straightforward.
All right, let's get into the insider strategy, the margin hack. Okay, now we're getting into an advanced, highly actionable strategy. Did you know you can legally pledge your ETFs to borrow up to 90% of their value in margin? It's true. This means you are essentially taking out a line of credit against your own assets. So you keep your core ETF portfolio entirely intact, letting it grow, while safely accessing capital based on its inherent value. It's a real game changer. So the absolutely crucial point is what you do with that borrowed margin. Our sources highlight that by utilizing this pledge, you can legally squeeze an extra 1% to 3% out of the market every single month. By smartly deploying that 90% margin, you are supercharging your returns, right on top of the organic growth your ETFs are already generating anyway. It is a true masterclass in capital efficiency. But hold on, before you just buy the very first ticker symbol you see, our deep dive suggests asking a few specific questions. First, what is the exact expense ratio? Second, does this ETF track a broad index, or is it a highly specific, narrow niche? And third, how liquid is it on a daily basis? Once you have those answers, you can follow the core thesis of today's explainer, direct from Billionaire Capital themselves. Stop paying massive mutual fund fees. Start compounding with ETFs. Subscribing to insights from sources like them is absolutely a fantastic way to keep discovering these crucial wealth secrets. So I'm going to leave you with this. Are you still letting massive mutual fund fees quietly drain your wealth? Or are you tied down by the exhausting illiquidity of real estate? The data has shown us a much clearer, vastly more efficient path today. It's time to restructure, cut the dead weight, and let ETFs do what they do best: compound your wealth. Thanks so much for joining me on The Explainer today, and I'll catch you next time.